Hey everyone, in this video I'm going to answer which one is the better dividend stock to buy for passive income investors in 2024. The two dividend stocks I'm going to compare in this video are AT&T and RTX Corporation. These two dividend stocks offer a robust dividend yield, but I'm going to look at more than just the dividend yield to answer which one is the better dividend stock. So let's get right into it. Let's look at the financial metrics that I consider vital when comparing two dividend stocks.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So I'll start with the dividend yield, but I'm going to point out that this isn't going to change my decision. AT&T offers investors a 6.47% dividend yield, and RTX offers passive income investors a 2.72% dividend yield. Now, I'm going to highlight that we shouldn't jump to conclusions here and just say that AT&T is the better dividend stock because its dividend yield is more than twice that of RTX. The dividend yield is just one factor among many I consider when making a decision of which dividend stock to buy. When I'm looking at a dividend stock, I'm looking at the next 5, 10, and 20 years. I'm not thinking about the dividend payment just for today. I'm thinking about it in the long run. Is that dividend payment sustainable? Is that dividend payment likely to grow? Those are some of the things I'm looking at, not just what it's paying right now. So with that being said, let's move forward. So one of the other more important things I look at is the operating profit margin. And according to this metric, AT&T is ahead here with an operating profit margin of 20% compared to an operating profit margin of 4.51% for RTX Corp. Additionally, AT&T is demonstrating the better trend in profit margin growth compared to RTX, which is moving in a downward direction. So those are the two things I look at with operating profit margin, not only the actual number, but also the trend. Is one improving and the other one not improving? Or is one improving at a faster rate than the other one? Those are important considerations to make when you're looking at a dividend stock, because ultimately dividends are paid from profits and cash flow. If a company doesn't generate sufficient profits and cash flow, then that dividend is at risk, because eventually you can pay dividends from savings and borrow money to pay your dividend, but eventually that is not sustainable, right? It's like a household. If you spend more money than you earn, you can sustain that for a short period of time, right? By using credit cards, by borrowing money, by dipping into your savings, you can sustain that lifestyle. But eventually, your earnings and your spending need to match. Otherwise, you need to bring down your spending to match your earnings, or you need to increase your earnings to match your spending in order to make it sustainable long term. It's the same thing with businesses. They need to sustain their dividends with earnings. Otherwise, it's not sustainable. There's risk it's going to be paused or reduced in the long run. The cash flow from operations are solid for both companies, $37 billion for AT&T and $7.8 billion for RTX Corp. No real trend upward or downward for either of these two over the last decade. There has been some volatility, but roughly flat for AT&T and RTX. So not much we can discern from that comparison other than noting that they both generate solid cash flow from operations to support a dividend payment. So now let's look at the prospects over the next 2 years for AT&T and RTX. For AT&T, growth is expected to be minuscule. 1.1% growth in 2024 expected and 0.9% in 2025 for revenue. For earnings per share, similarly small numbers, 1.5% and 1.2% for AT&T. Meanwhile, RTX has better prospects over the next 2 years. Revenue growth expected of 7.2% in 2024 and 6.6% in 2025. Earnings per share, meanwhile, expected to grow by 7.6% in 2024 and 18.6% in 2025. Additionally, RTX is demonstrating second derivative growth. What do I mean by that? Well, look at the earnings per share over the last 3 years. This is 2023. When it's all said and done, it's expected RTX will grow earnings per share by 4.6%. And then that rate of growth will increase to 7.6% and then increase to 18.6%. So not only is the rate of growth positive, but the rate of growth is increasing from 4 to 7 to 18, right? Where you see the opposite in revenue. 10, 7, 6, 4, 7, 18 is increasing, and earnings per share is more important than revenue growth. I'd prefer a company growing earnings per share much more than I'd prefer a company growing revenue. Ultimately, RTX is expected to grow both earnings and revenue, but growing earnings at an accelerated rate while growing revenue at a decelerating rate. I also wanted to compare these two companies on their long-term debt to see if there's any risks here. And for AT&T, I do notice a mild risk with $138 billion in long-term debt compared to its cash flow from operations of $37 billion in the trailing 12 months. The risks of long-term debt are moderate for AT&T, less so for RTX with $35 billion in long-term debt and $7.8 billion in trailing 12-month cash flow from operations. I will highlight that both of these businesses have a nice runway where they can see their business. RTX has significant backlogs of orders that it's going to take years for RTX to work through. So RTX knows, for the most part, what its revenue and profitability is going to look like for the next year or two. Because of that backlog, it knows how much sales it's going to generate because it already has orders that it needs to work through. AT&T, for a different reason, knows pretty much what its revenue and profit is going to look like because AT&T's customers, more than 99% of them renew. And so it's not a growth industry. It knows it's not going to attract very many new customers. Its business is primarily going to be based on recurring customers and multiplying how many customers they have by the average revenue per customer, and they could pretty much see what their revenue is going to be like for the next year or two. So for that reason, when companies have that kind of visibility, the long-term debt is not much of a risk, but it is a risk should there be some sudden change in their business, some sudden bad case scenario that comes up, then the long-term debt will be a risk. And finally, I wanted to look at their valuation. AT&T is trading at a forward price to earnings of 6.9, while RTX is trading at a forward price to earnings of 13.57. I will point out at this point that if they were both trading at the same valuation, I would have chosen RTX stock as a no-brainer. However, since RTX stock is almost twice as expensive as AT&T, it's made this choice a little more difficult. RTX has much better prospects going forward over the next 2 years with accelerating earnings growth and much larger earnings and revenue growth compared to AT&T's pedestrian growth expectations. But at the same time, AT&T has much better profit margins than RTX, and AT&T's profit margins are improving while RTX's profit margins are worsening. Finally, the valuation makes AT&T look more attractive than RTX. However, if I was going to choose which one is the better dividend stock to buy today, RTX would win this battle slightly. Very slightly, RTX wins this battle as the better dividend stock to buy today, primarily because of the better prospects over the next few years. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.